Welcome back everyone to the Moneycontrol live stream. You are watching Markets with Santo and CJ. Well, it seems it's a very range-bound session today with the bulls, although giving up some ground but not giving up all of it. We have had some sort of buying coming in at lower levels, and but the indices, it seems, are all set to snap a 3-day winning run at this point of time. Both Nifty and Sensex are firmly in the red, but not losing too much of ground. That is the only good part for the bulls.
They will start losing ground in a couple of days.
I don't think so. Yeah, but of course, we will have to be wary of what happens in another half an hour, because there is a possibility of a big chunk of FII selling coming because of the MSCI rebalance. So we will have to wait and see whether there is some buying, whether the market will be able to absorb that or not. Apart from that, if you look at the global cues, Asian markets were largely mixed after the Chinese data that came out on the manufacturing side. Another month of contraction, although it was above expectations of economists, but largely a very flat trade in Asia at this point of time. Apart from that, global crude oil prices have again come to the fore of concerns for investors, especially in India, given that we import so much of our oil. Global crude oil prices shot above $120 per barrel after EU imposed another set of sanctions, with now 90% of the Russian oil exports under threat of being, destroyed in that sense. Apart from that, metal, media and auto sector, these were the three sectors that were holding fort for bull Santo. And clearly metals, of course, after the Chinese data that came out, the metal sector saw a good amount of buying at the lows.
Well, CJ, you flagged off some of the concerns yourself. High crude oil prices, clearly one of them. And I think market is still underestimating the problems that high commodity prices can cause for user industries. That's a big negative. At this point, I think we could see some bit of consolidation, but the medium-term trend, CJ, the feel I get speaking to people is that market is likely to slip lower from here on. You're not still seeing any big buying emerge, and there are no triggers for that. There's no reason why people should come and chase prices at these levels. Mind you, first quarter earnings are not going to be a very pretty picture. So that said, people are clearly on the back foot for now. So my bet is, CJ, you could see the market drift lower.
Well, but the bulls will argue, Santo, that a lot of the negativity has been priced in, and although markets may not have seen that much of a price damage when you talk about the benchmark indices, but at individual stocks level, we have seen decent amount of correction from their record highs, and therefore there is an argument that valuations have reached a zone of reasonableness, and therefore it might start attracting a lot of the investors who are sitting on the sidelines for a long time over the past 6 to 7 months, fearing that valuations were too high, and therefore getting in right now would not be appropriate. So I feel that there is still scope for this pullback rally to head towards 17,000, 17,100, and we will have to see whether that probably would lead to some emergence of more confidence within the bulls.
CJ, there's a saying in the market that the bear market doesn't really start till the last bull has been suckered in. So every time there's a correction, a lot of people sitting in the sideline feel that, okay, 6-8 months back, the stock was available at 3 times this price, and right now it's a good buy. So that's a trend we are likely to see. Also on the consumption part, we are now hearing about a lot of layoffs in the techs, in the startups especially. And that, I think, could have a knockdown effect on the salaries in some of the other sectors also, and this, I think, somewhere could have an impact on consumption.
Well, it could be good news for IT sector, although, because a lot of the employees that left from the IT sector ended up being hired by startups at 3 times, 4 times salaries. So probably for the IT sector that might be a good news in hindsight.
You're looking at it through a very narrow prism, but anyway.
That said, let's dive into some of the key stock actions that were in the focus during the trade, starting off with
Goodyear India. Now, CJ, I think this is now a market very clearly where you will have to look at preservation of capital, protection of capital, and rather, as they say, return of capital rather than return on capital. So I would be very comfortable owning some of the good dividend yield plays at this point if I were to make a portfolio. Now, Goodyear India, tire company, sales growth has not been all that growth, but just look at the dividend the company has paid out over the last 5 years. It's given about 241 rupees, 241.5 rupees to be precise, in dividend over the last since 2016. Also, it's not just purely a dividend play. Over the last 6 years, the stock price has also appreciated a fair bit. So when you put together both the dividend payout as well as the stock price appreciation, it's been a pretty decent run. Of course, not a great multi-bagger of that kind. Also, Goodyear supplies, it caters to the passenger car segment and also the farm segment. So it's a major provider of maker of tractor tires. So this is, I think, something which will, which should do well here. It will be a steady growth as far as the earnings are concerned, but a good stock to have in the portfolio purely from a dividend yield point of view.
Well, Santo, in general, in Indian market history, betting on dividend plays has never really worked out for investors. If you look at some of the stocks that are high yielding, high dividend yielding, they're also largely PSU companies, and they do not tend to do well. Goodyear itself, its own performance, if you look at the longer term track record, is not really much to speak about. And I feel that by focusing too much on dividend at this point of time, while you may be able to protect your capital in the short term, but you're taking a very, very short term view on the market when there is a play out there in different sectors, not only in automobile, to probably bet your money on 3 or 4 years of growth going ahead. So for me, I don't really buy this dividend argument. Apart from that, coming back to the fundamentals, right, auto sector as a theme definitely is a good place to be in at this point of time. The sector is seeing a turnaround, and auto ancillaries such as Goodyear are likely to benefit. But if you look at Goodyear in particular, it does not really stand out even within the sector or the subsector that it is part of. Its profitability, its sales growth has largely been about 10% over the past 5 years, which is not really inspiring when you're trying to chase growth or you're trying to chase return on capital. Apart from that, the profitability is also below average. In that sense, if you're going to play the auto theme, if you're going to play the auto revivals theme, it's better to probably bet on some of the sector leaders such as MRF and Apollo Tires than to go for a laggard like Goodyear, in my view.
Well, last year for the June quarter, the company did pretty well. In fact, if you look at for FY22 also, there's a 35% almost growth in earnings, except that high input prices has eroded that. So it's catching up with the rest of the industry very clearly. But as I said, this is primarily a dividend yield.
Well, one stock that is looking quite well despite all the skepticism around it is Delhivery. The company recently IPO'd amid a lot of backlash from investors in terms of its valuation. But if you look at the numbers that the company has released for the March quarter, it's quite decent numbers, Santo, quite a resilient quarter. Sales have grown more than 2 times on a year-on-year basis, while losses have remained flat. They have actually not accelerated as a lot of investors and analysts were predicting before the company's Q4 earnings. Apart from that, in a very important development, the freight handling charges for the company have reduced significantly. They have seen almost 300 to 400 basis points improvement on a year-on-year basis, which is also showing that profitability, the outlook on profitability is also improving for the company, and it's also handling its costs quite well. So for me, we have already seen a decent amount of bounce back in the stock after the dreadful debut after the dreadful profit booking, following a decent amount of debut when it listed about 10% premium. But for me, Delhivery now could emerge as one of those value plays in the space, even though probably somebody like you might not actually think of it as a value and a growth stock.
Simple. CJ, I just have one question for you.
Yeah.
Okay. Consider valuations. Delhivery's market cap right now is almost 38,000 crore,
right,
which is equal to the market cap, or in fact greater than the market cap of all the other listed logistic companies, right?
Yeah.
And Delhivery is loss making. All the others are, most of the others, I'm not saying all of them are not just profit making but available at very reasonable valuation.
Right.
Okay, look at someone like a Blue Dart, for instance. Your company's market cap is about 4 times annual sale, right, and it's making hefty amount of profits. And compare something like Delhivery, it's loss making and its market cap is 6 times annual sales. I mean, what's the justification? How do you make money on this stock?
Is Blue Dart providing you 200% sales on a quarterly basis, sales growth in a quarterly basis? No,
well,
right?
Delhivery did grow its sales rapidly, but also then look at it, its operating profit isn't there. So expenses have also gone up.
It will not be at this point of time because it is in great growth stage. It is acquiring new customers. It is trying to invest in its brand. It is trying to build its distribution network. So of course, expenses probably will be higher than a lot of the established players in this point of time. But Santo, if you're looking for asymmetric gains in this market, you always have to put your bet behind a disruptor in the industry, not the incumbents, right? I mean, we have seen that time and again in every industry you talk about, be it computers, be it cell phones, be it telecom, right? You always put your money behind a disruptor who has something to disrupt with. And Delivery clearly has a good disruption proposition at this point of time in the logistics space, which is also forcing a lot of the incumbents also to change themselves. So in my point of view, the growth is what the valuation is reflecting, and probably that is it. That is it. And the losses, as far as the losses are concerned, profitability will emerge. Sooner rather than later, profitability will emerge because the company itself has stated during its IPO that they want to grow with profitability, not without it.
Of course, every company intends to grow with profitability.
But there are some companies who are not bothered about profitability.
How soon they deliver it, I think that is the big question. Margins overall in the logistic industry is not all that great. Well, best of luck. These stories look very good as long as the price is rising. Tomorrow if the price takes a knock of about 20-30%, the stock price falls by 20-30%, the entire narrative will
Santo,
very
that
quickly
is true
change.
for any company, whether it's profit making or loss making. That is true for any company, right? In the morning, earlier in the shows, you have also talked about some of the profit making companies which have exorbitant valuation and gone through correction, but they are still profit making, right? And this is a cycle.
This one is not. That's my whole argument.
Every stock's life. This is a cycle that every stock has to go through.
Words of wisdom from CJ. Anyway, the third stock on our watch list is Sumitomo Chemical. CJ, this is a leading player in the crop protection segment. Now, this segment is very interesting. Monsoons are expected to be good, right? Food prices are rising. Now, rising food prices is usually a good thing for farmers.
Right.
They are able to make, and because their incomes rise, they are able to buy better fertilizers and also crop protection products. And this is good news for people like companies like Sumitomo Chemicals, which is both marketing some of the proprietary products of its parent, Sumitomo Chemicals of Japan. In addition, Sumitomo has acquired Excel Crop Care because of which now it supplies the entire range of products, right from generics to specialty crop protection products. Also, it's got a pretty strong network and consistent growth in earnings over the last 5 years. Almost 31% compounded growth in top line and about 48% growth in bottom line. This is a steady performer. Even if you look at the stock price since the lows of March 2020, it's been climbing steadily without too much volatility. So this, I won't say it's some kind of a multi-bagger in the short term, but very clearly one stock where you don't necessarily have to lose sleep.
But Santo, past performance is never a guarantee of future returns, right? That is what they always say. So the stock might have done brilliantly in the past, but that is never it should never be a barometer for how it's going to do in the future. When you're talking about the company itself, I take it agriculture as a theme, crop protection as a theme is brilliant at this point of time, given the global dynamics that we are seeing. But I feel that on this, I would probably concur with HSBC India, who are also of the view that export-related themes within the agriculture crop protection space in India would probably do much better than companies which are more focused towards the domestic market, right? If you look at some of the, if you look at Sumitomo Chemical's export contribution, it's quite low compared to many of its peers. Large part of its revenues actually comes from its products that are sold within the Indian boundary. So for me, there are better plays out there in the crop protection segment, like UPL, like PI Industries, which are more export focused. Apart from that, there is risk to margins for agriculture, fertilizer, agriculture chemical companies like Sumitomo, because input prices are also rising. We at this point of time, government has been raising subsidy and not been asking the industry to do anything about it. But there is a possibility, the way we have seen, how the government has come cracking down on the steel space, how it has come cracking down on other sectors. There's a possibility, or at least a risk, that price, curbs could also come in for the domestic crop protection sector. So that is one risk that we cannot look away with. Also, when you look at the product profile of Sumitomo, it's largely made up of generic products which have low margin and are at greater threat of competition than specialty chemicals. Yes, the specialty chem space has been rising, especially after the acquisition of SL Crop Care. But I feel given the higher proposition of generic or higher composition of generic products, the low margin profile is something that will probably deter me from betting on Sumitomo than some of the other more lucrative options such as UPL and PI Industries.
Counter argument: the company has managed to maintain its margin, and you can see the growth in bottom line consistently. Last 5 years,
there are many ways to grow bottom line. Santo, you and I.
31% growth in revenues as well. I don't think so, CJ.
That said, one stock that is looking quite interesting is Visaka Industries. Well, the company's Q4 numbers were quite interesting. Highest ever quarterly revenues, even though the bottom line took a little bit of a hit because of higher input costs, but the high revenue growth suggests that there is a large potential for growth there for the company. Apart from that, the company has in the recent years been investing heavily to expand its capacities, both in the board business as well as the yarn business, and those capacity expansion plans are now complete. So the company is all set to reap dividends from that, from the new capacity, and therefore it is very likely that revenue as well as earnings are going to compound quite substantially from here on. If you look at the board business, they are guiding for about 15 to 20% annualized growth in sales in FY23 alone, and in the yarns division they are expecting about 10 to 15% growth. So a very cheap stock, a small cap to mid cap stock, which is priced quite cheaply at this point of time, but also giving a very strong growth outlook, and therefore probably a good bet for a longer term at this point of time.
Well, CJ, I can't really pick holes in this one. I went through all the numbers and everything. You're right, the stock is pretty cheap. But when the market ignores a stock that's pretty cheap, I then begin to wonder why. So the stock hit a high of 852 back in August 21.
Yeah.
And since then it's been falling, and it's fallen almost 40%. There's been no sign of recovery. So my question is, why is the market ignoring
I think Santo, that is the correction is in line with general correction that we have seen in the small cap and mid cap space, right?
But many have recovered. This one hasn't.
That is true, and this one also showing signs of recovery after the March quarter earnings, right? If you look at the average decline for a small cap stock is in the range of what, 35 to 40%. So is decline in line with the average small cap stock out there.
The difference is this has the valuation comfort. That's why it caught my attention.
It has the valuation comfort right now, right? After the 40% decline. Maybe in August 2021, it did not have that valuation comfort that probably we are looking at right now. And because the valuation comfort had come in, plus the strong growth guidance, I feel it just makes so much sense to get into the stock at this point of time for me.
Okay, we'll take a quick look at the market before we move on to the last stock. So Nifty mid cap under pressure, down about 76 points. Index is also slightly down. Nifty has now fallen 100 points almost. Is that? I think that's a pretty steep fall.
Yeah.
I think we were talking about a huge sell-off in the last half an hour of trading, and that's coming true.
Yeah, I mean, when we started the show, the index was down about 0.3% and is down now about 0.6% to 0.8%. Nifty Bank is the one that is leading the losses at this point of time. If you look at the Nifty Bank index, is down about 1.1%. Interestingly, the second line stocks are doing quite well. The Nifty mid cap 100 index is down only 0.3%, so it has not seen too much of a deterioration there. Whereas the Nifty small cap 100, Santo, interestingly, is higher by 1.2% at this point of time, which is a very, very good sign.
Well, more Robin Hoods, as they say.
Yeah, definitely. Retail is coming.
Fools rush where angels
fear
to tread.
Come on. I don't think you can use those quotations now. Maybe 6 months ago, you could have bashed us for being fools. But at this point of time, given the way the market has corrected, given the way valuations have seen compression, I feel if retail is buying right now, maybe they are just being smart.
Okay, I was just referring to a phrase, not exactly calling. The last stock on our watch list is Dixon Technologies. Now, CJ, fourth quarter numbers just about on expected lines, but this is one of the theme stories where I think the market is no longer buying, and that probably explains the sustained underperformance in stock price over the past few months. There's a report by Goldman Sachs which says that valuations at about 47 times FY24 earnings.
Right.
That's like huge when you compare that. Almost globally, companies with a similar business model are quoting at about 11 times. Now I know CJ here will say about the India growth story and all that, but you just can't avoid expensive valuation. You can't overlook the fact that there are expensive valuations. Can you, CJ?
Santo, I don't feel that the stock is expensive. I mean, if you're getting 50% year-on-year growth on sales, what more can you ask for? I mean, at 47 times, yes, it's not cheap either. It's not like it's dirt cheap and it's just begging and crying out to be bought, but definitely not so expensive that it will make your eyes water, right? If you look at the guidance that the company has given, they're expecting about 50% growth in sales in FY23 without any hit to margins. They expect to at least maintain the FY22 margins, which anyway had taken a hit due to higher input prices, or better it by at least 30 to 40 basis point, right? And let's not forget, Dixon Technology is not a 1 year or 2 year story, right? When the rally started in the stock, the entire rally started with the government's intention to bring in PLI schemes to make India an electronic manufacturing hub. And therefore, this is a 5 to 10 year story, my friend. And with the management also indicating that they expect to improve their return on equity from 25% currently to almost 30% next year or in another 2 years, I just feel that 47 times for a 10-year story might look very, very cheap when you look back at it in another 5 to 10 years point of view.
Well, I'm really surprised, CJ. Now every story almost has become a 10-year story.
Absolutely. This stock was always a 10-year story, right? It was always a 5 to 10-year story because you're looking at a sea change in India's export story. When you're talking about the PLI schemes will not benefit you tomorrow or day after tomorrow. It is going to benefit you 3 to 4 years in timeline. The same thing that we saw in China when they brought in such subsidies or export SOPs for their industries. So I feel that Dixon, given that it's trying to get into newer segment, it's trying to reduce its dependence on 1 or 2 clients such as Xiaomi. I feel this company, being a contract manufacturer, will continue to gain a lot more traction and a lot more market share in India, and therefore the valuations at 47 times might seem expensive in the near term, but probably may not be in the longer term.
Well, no let up the selling pressure on the Nifty and Sensex. Sensex is down by about 450 points at this point in time.
Yeah.
So, CJ, what is it that you are looking forward to? What's on
the
horizon?
Santo, the earnings season are over now, so we don't have any earnings to watch out for. But there is the Q4 GDP growth data that will come out later today for the Indian economy. So that is something that investors will keenly watch out for. They will want to look at some of the individual segments, such as how is capex fared, how is manufacturing fared, how is personal consumption expenditure fared, because this is one part of the economy, personal consumption, which has not yet gone back to pre-pandemic level. Plus, it has been hit by a rural slowdown as well as rising, commodity food prices and whatnot. So for me, internals will probably matter more than the headline number in terms of GDP. We know that there is an expectation that GDP is expected to slow down on a sequential basis, but internals is what will be crucial for the market. Apart from that, auto stocks will be in focus. The May sales data will start coming out from individual companies from tomorrow itself, so that sector will definitely be dominating the headline. Apart from that, the Caixin Chinese manufacturing PMI data, along with India's own PMI data, will also come out. Yes. Earlier today, we saw the official PMI data coming from China, which showed a sequential contraction, but it was still above estimate. But tomorrow, private sector data will come out, so that will also give a bit better picture in terms of where the Chinese economy is standing. Plus, our own Indian PMI data is also going to come out, and we will have to see, given the power crisis that we had seen in April, right, what sort of an impact will it have on the industry. If we sail through that, probably that will also boost confidence in the economic growth and the economic recovery.
Well, that's all that we have in this edition of Market with Santo and CJ. Hope you enjoyed watching the show. Please do share your comments in the feedback section below.
And also keep following us on the social media links at the bottom of your screen. And for rest of your financial markets updates, stay tuned to moneycontrol.com and the Moneycontrol app. We will catch you live again 9 a.m. tomorrow. Till then, have a great day.